the traditional approach. In this session, we will be discussing how a modern approach is applied. It's actually simple. The assets or expenses has to be debited if they are increasing, and if there are liabilities, capital and income, you have to credit if they are increasing. Just remember this rhyme: assets and expenses are debited when they rise, liabilities, capital, income get credited to the skies. Isn't it funny? So the rule is, asset you have to debit if there is an increase and credit if there is a decrease. Expense, debit if there is an increase, credit if there is a decrease. Income, increase, if it is increasing you have to credit, and decreasing you have to debit. Capital, again, if it is increasing you should credit, and decreasing you should debit. And liabilities, if it is increasing you should credit, and decreasing you should debit. In our upcoming videos, we will be discussing in detail about the problems in the form of transactions. We will be analyzing the accounts as per traditional approach, how we have to classify, and classification as per modern approach, and the impact of accounts to the business, whether increasing or decreasing, and ultimately journalizing the transactions. But let us take an example here. Let us follow our fictional business coffee shop, which is run by Bobby, coffee entrepreneur. Bobby purchases a fancy new espresso machine for 5 lakh rupees in cash or check. Rather check, because 5 lakh is involved, right? Check. So Bobby purchases a new espresso machine for 5 lakh rupees through check. The two accounts involved here is the coffee machine and the bank account, isn't it? So coffee machine, as per modern approach, it is an asset. When you are increasing you have to debit, and when the bank account through check you are giving to the supplier, bank account will decrease, the asset is decreasing, you should credit. So it's like a financial seesaw. When one side goes up, the other must come down, isn't it? So this is one of the example. Another example if you can take is, if the Bobby buys coffee beans worth 10,000 on credit from Supreme Bean suppliers. So here the two accounts involved here is purchase account and Supreme Bean supplier. Purchase account being in the nature of expenditure, since it is increasing, you have to debit. Whereas Supreme Bean supplier is a creditor which the business owes to them. It is like a liability which is increasing, you have to credit. So purchases is an expense account that is increasing, so it gets a debit. Supreme Bean supplier is now a liability, business owes them money which is increasing, so it gets a credit. So, why do accountants insist on this particular double entry drama? It's your financial fact checker, and it helps calculate profit or loss accurately. It shows the true financial position, and it lets you control and track every financial move. It helps you compare performance comparability. To conclude, remember, every journal entry tells a financial story with two equal but opposite sides, like Newton's third law, but for money. To remember the steps for journalizing, first you have to ask the question, is it a transaction? Students, please refer our previous videos where we have discussed in depth about the business terminologies. In that video, we have discussed the transaction. So first step is identify whether it is a transaction. Second, identify two accounts involved. And third step, determine their nature as to whether they are asset, liability, income, expense, capital, etc. And next step is to decide which account has to be debited and which account has to be credited. And the last step is record equal amounts on the both sides. Just remember this, for every financial action, there is an equal and opposite accounting reaction. Being able to journal correctly makes you an accounting superhero, saving businesses from financial chaos one balanced entry at a time. So here is a quiz time. If you pay this month's rent in advance, which account would you debit? Just think. Will you debit rent expense or prepaid rent or cash or accounts payable? The answer is B, prepaid rent. It's an asset that is increasing because you know now have the right to use the property for the period you have paid for. And that's journalizing in a nutshell, where double the entries mean double the fun or at least double the accuracy. Remember, in accounting, it takes two entries to tango. Thank you, and please like the video and share this with your friends and subscribe our channel Lator Academy. Thank you.